Imagine a grand old castle. It sits on a hill, strong and imposing. What is the one thing that keeps it truly safe from attackers? It is not just the thick stone walls. It is the wide, deep moat that surrounds it. This moat makes it incredibly difficult for enemies to even reach the walls. In the world of business, Warren Buffett looks for the same thing. He searches for companies that have a protective moat around them. This moat is not made of water, of course. It is a special quality that keeps competitors away, protecting the company's profits and its place in the market for many, many years. This simple idea is the cornerstone of his entire philosophy. Before looking at spreadsheets or financial reports, he asks a fundamental question. Does this business have a lasting advantage that keeps rivals at bay? A company without a moat is vulnerable. A new competitor with a cheaper price or a slightly better product can come along and steal its customers. But a company with a strong moat can withstand these attacks. It can maintain its profitability, its customer base, and its strength through good times and bad. So, what exactly is this moat that Buffett talks about? In business terms, he calls it a durable competitive advantage. Let's break that down into simple words. Durable means it lasts for a very long time. It is not a temporary edge that disappears after a year or two. Competitive advantage means the company has something special that its rivals do not have and cannot easily copy. This special trait is what allows the company to consistently earn good profits. It is the secret sauce that keeps customers coming back and competitors scratching their heads, unable to figure out how to steal the business away. These advantages can come in several forms. Brand low-cost patents network. Effect. One of the most common is a powerful brand. Think of a product you buy without even thinking about the alternatives. That loyalty in your mind is part of the brand's moat. Another type of moat is a cost advantage. This happens when a company can produce its goods or services much more cheaply than anyone else. Now let's explore another of Buffett's powerful ideas. He sometimes thinks of stocks in certain companies as equity bonds. This might sound a little technical, but the concept is beautifully simple. First, think about a regular bond. You buy the bond for a set price. In return, it pays you a fixed amount of interest every year. Like clockwork. It is predictable. It is steady. It is generally considered safe. You are not expecting it to double overnight, but you count on the reliable cash. Some of the very best businesses behave in a similar way. These are not risky, high-flying tech startups. They are established, dominant companies. They have wide, durable moats. They generate predictable and growing profits year after year. When you buy a share, you buy a slice of that predictable cash stream. Some is paid as dividends, some used for buybacks, and some reinvested for growth. This is why Buffett calls them equity bonds. They are equities, stocks, but with bond-like predictability. Unlike a bond, an equity bond can grow. Prices can rise, markets can expand, efficiency can improve. Your interest, the earnings per share, can increase over time. This transforms how you see stocks. You own a claim on real business earnings. If the moat is intact and earnings grow, you can sleep well at night. Your equity bond works quietly with the added power of growth. One of the clearest examples of a moat is a powerful consumer brand, and there is no better case study than Coca-Cola. Think about it. Walk into almost any store or almost any country on Earth, and you will find that iconic red can. People know what it is. People know what it tastes like. People have positive feelings from a lifetime of advertising. That powerful connection inside billions of minds is Coca-Cola's moat. It's an intangible asset, more valuable than its factories and trucks. Many companies have tried to make a rival cola. They can analyze the formula and make something similar. They can even undercut on price, but they cannot replicate the brand. Decades of memories and association with happiness and togetherness. Buffett saw this in the late 1980s. Coke's global reach and unwavering customer loyalty. He invested over $1 billion and treated it like an equity bond. He knew Coke would keep selling drinks and generating cash, dividends, buybacks, steady growth. He ignored short-term noise and watched the moat. Decades later, stock and dividends rose. A powerful brand became a safe, profitable long-term investment. Another of Buffett's favorite businesses, and a less obvious moat, is insurance. On the surface, insurance can seem boring. People pay a premium. In exchange, the company promises to pay for a specific loss if it happens, like a car accident or a house fire. The moat isn't as visible as a famous brand, but it can be powerful, rooted in how the money is handled. Insurers collect premiums today, but may not pay claims until much later, if at all. This creates something Buffett calls float. Float is a massive pool of money from customers that the insurer gets to invest for its own benefit. If policies are priced correctly so premiums exceed claims, the insurer profits in two ways: from underwriting and from investing the float. This engine powered Berkshire Hathaway. Buffett bought well-run insurers like National Indemnity, generating steady float. He then invested that float in great companies, Coca-Cola, American Express, using other people's money to build his fortune. Scale and reputation are the moat. Spread risk across millions of policies. A trusted brand attracts customers. Hard for startups to match. A cash-generating machine. Profitable insurance plus float helped transform Berkshire from a textile mill into a global giant. That's basically it. Not all moats belong to giants. Some live in smaller, simpler businesses. Buffett has a fondness for companies that do one thing very well and earn loyal local or regional followings. See's Candies, based in California, is a perfect example. Bought in 1972. Not high-tech, no complicated model, just delicious, high-quality chocolates people love. The moat, beloved regional brand and habit. For decades, See's boxes were gifts for holidays, birthdays, special occasions. It became a tradition. When Valentine's arrived, people thought, I need to go to See's. Loyalty reduced ad needs and created pricing power. Customers paid a little more for a trusted product. Buffett and Munger saw a wonderful economic machine. Low capital needs, loyal base, and the ability to nudge prices with inflation. Customers stayed happy. See's threw off remarkable cash relative to its size. A small-scale equity bond, predictable, growing profits from a simple business. Over years, it generated hundreds of millions for Berkshire, far exceeding the purchase price, and helped fund new investments. A testament to the power of a simple moat, small but mighty. How did Buffett combine moats and equity bonds to become so rich? The method is straightforward, but requires immense patience and discipline. 3 core steps. Step 1. Find businesses with wide, deep, durable moats. He reads and thinks. How a company makes money and what protects it. Business analyst first, stock picker second. He wants a piece of a truly great enterprise. Step 2. Buy great businesses at a fair price. Even great companies are bad investments if you overpay. He waits to buy quality at reasonable prices, often during panics or temporary bad news. When others are fearful, he's greedy for quality at a good price. Step 3. Hold on. Favorite holding period, forever. Putting it all together, we see how these simple steps created a mountain of wealth. Slow and steady. Focusing on durable moats reduced risk. No gambling on unproven ideas. He invested in proven winners. Quality and safety built the foundation. Avoid big losses. Equity bonds kept capital flowing. Coke dividends, insurance float, and See's profits supplied dry powder, so he could buy more when markets panicked. Existing assets funded future growth. Holding turned great returns into legendary wealth. By holding Coke, he captured its global expansion and dominance. Earnings grew from a stream to a river. Compounding is growth on growth. Applied to quality, time is the most powerful force. What is the lesson for the rest of us? It's not about being a stock market genius. It's about changing how you think. Stop trading symbols. Start owning businesses. Find the best businesses you can. Built to last. Prefer what you understand. Seek clear advantages. Ask, what is the moat? Brand trust. Low-cost edge? Hard to switch customers? If you can't answer easily, move on. When you find a strong moat, think of it as an equity bond. Ignore daily swings. Focus on steady, growing earnings. If the business is healthy and the moat intact, price follows. Own a piece of earnings power. Stay calm in panics. Avoid bad sales. Adopt the long view. Choose good ground, plant strong species, water, then give it time. Find great companies, buy at fair prices, and let decades compound. Buffett's true secret is patience. Plant trees with deep roots and grow a forest of wealth.